Hey guys, thanks for tuning in. It's Yarly G. Today I'm going to be talking about your basics to investing assets.
Hustle, 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 step. Move, and make it back. First we gotta hustle, so we get the cash.
What are assets? It's pretty much transferring your money and converting it into shares or even buying a home. All these things are assets, but I'm mostly going to be focusing on the stock market side of things. So that involves not just stocks, but mutual funds as well. The first thing we have to do is convert some money into those assets, right? What I use to invest, there's Robinhood, which I use for my stocks. Most of my money is in stocks. And then I also have mutual funds. Mutual funds is more conservative money that I know if an emergency happens, whatever I need access to it, it's available. Buying stocks is is you investing in a company by buying a portion of that company in what they call shares. So the more money the company makes, typically what happens is more people will buy into it. If people don't buy into it, the stock price will stay pretty much the same, even if the company's making more money. Like investors have to get out there and actually buy more shares of the company. And there is usually a correlation between the more profitable the company becomes, the more people buy into it. So it is a strong correlation, but they don't have to be correlated in such ways. Mutual funds is a range of stock. It's a combination of stocks. So what they'll do is for example, I know Invesco has a technology fund, which will have maybe Tesla, Facebook, like all these different tech companies. And then they'll buy and sell a portion of shares into a portfolio, which they manage. And then all that combined into one single share. So think about it as one single mutual fund is actually like one portfolio that you're willing to invest in. They manage it. You're just there to reap the gains and benefits of such things. It's more conservative. As the market goes up and down, it follows the same pattern as the market versus a stock, which is much more riskier, where if the company does bad, the whole stock of that company does bad, but the overall market will stay pretty much consistent to the pattern that it has been following. We have to really balance how much do you want to put into stocks and how much do you want to put into mutual funds. As you get more advanced, you'll learn how to separate the two and allocate money to the two at different times. But as a good rule of thumb to start is do 50-50 or even 60-40, like do 60% into mutual funds and 40% into stocks. So that way, because stocks you're learning, you're playing around with these numbers, which you don't know how it's gonna come out. Don't be risky at first and play the safer way. These companies that I mentioned, I'm not endorsed by them. I use Robinhood to invest my stocks because it's free. And I also use Ariel Funds. It's a fund that a friend of mine has put me on to, and it has brought me returns after returns all the time. So it's very important that we share with one another what we're using and see what works. Because I feel like all these things, they don't have any ratings, so you don't know which one to use. But from my experiences, those two are good ways to start. In terms of stocks, when do you buy a stock, right? And which stock do you choose to buy? I mostly invest in the tech world because that's what I know. I'm very familiar with that, as well as a bit on the medical side of things. So some medical tech companies I have invested in. The best days to buy a stock is when it drops like crazy. That's the day that you get in, not just when it drops moderately like 2%, 3%. You gotta wait for a day where it drops like 10%, 15%. And this could be over the course of a week or a month. It doesn't have to be one single day. You just have to wait for that drop to happen so drastically. And then you get in at a point. There's no perfect time of buying at that point on. You just have to ride the wave until it rebounds back. It's always a curve. It always goes this way, it drops down, but it'll eventually come back. So if you buy at any point during that drop down, you're guaranteed to make some gain. And ensure it's a viable company. Don't just go and invest in a company that you see is becoming a penny share, but then it doesn't have anything viable about it. Ensure that it's a company that you know about. You see that they're doing some business, and it's just that they had a bad sales report, but their business will keep going on. So pay attention to that. A good return on a stock is that after you put that money in, it brings you back 10 to 15% of what you put in, then you sell it, right? That's a more conservative way of buying and selling stocks. When you get more advanced, you can wait for like a 30%, 40% mark, especially if you hold it longer. The practice that I'm showing is just some basics. So to get you started, to get your foot wet, 10 to 15% off $1,000 is about $100 to $150. So if you invested $1,000 into a company, you bought like some $1,000 worth of shares at 1,100. Once it hits 1,100 mark or 1,150, then it's a good time to sell, get your returns, and then you wait for another bad day to happen and you go buy into it. They don't consistently go up. It's always going to keep going down and coming back up. So if you always buying on the way down, you're guaranteed to make money when it goes back up. So always be on the lookout for that. And the same rule applies for mutual funds. You should try to get 10 to 15% return. A good rule of thumb is that you should try to get at least 7% return on your money over the course of X amount of years. So the scenario that I was showing you before, as I previously mentioned, where you're able to save $875 a month, which is $10,500 a year. Over the course of 10 years, that number is $105,000. However, if you're investing it into mutual funds and stocks and you're returning at least 10% a year, that number is doubled. It's $210,000. So why not do it? You're beating out inflation as well as you're growing out your money. Remember, inflation is 3% a year. Right? So your money's devalued. If you just let it sit there as cash or in the bank in a savings account, you're losing money every year. Why not put it into these funds when you know you don't need those money right away? Like, we're only spending those big chunks of money certain times of the year. Our regular salaries, like 75% of our salary, should take care of our rent, all of our expenses, as well as money that we need to shop around, et cetera, et cetera. Like, the other money that we need is for big emergency purposes, which we don't have all the time. So it's better that you put it towards these stocks and different assets. Do not let it sit in the bank and just collecting dust. So how do you look at mutual funds, right? Mutual funds can be tricky, but I think it's a good way to learn. A mutual fund is pretty much a stock. It's a more conservative stock. So one thing I do is there are 3 indexes that tells you how the market is doing. So that's the Dow, NASDAQ, and the SP 500. These 3 indexes are the majority. There are others as well. There's gold, oil, Russell 2000, all these things. But I think for the most part, these 3 will relatively tell you how the market is doing. You don't need to follow all 3 at the same time. You could just pick one because they usually go up and down together. Like, if one is red today, the others are most likely red. Like, 99% of the time, they increase, they go down and decrease by the same amount every single day. Let's look at Dow. Let's look at a good time to buy, right? So Ariel is, like I said, is one of the funds that I invest in. On July 30th, Ariel was at $47.13, right? We see that it's been going up. It's pretty much flattened. And you can see on the same day, the Dow was approximately about the same amount. So let's look at this scenario. On July 30th, the Dow was at $27,198, right? While Ariel was $66.91 a share, right? The mutual fund. It was definitely not a great time to buy because, as you can see, it's been flattened and it's been going up steadily for the past few months. What do is you wait for a day that it drops down. And that's exactly what happened. If we waited until August 20th, right? See what happened on August 20th? Just around that time. And you're never going to get the day perfectly right. You just have to wait for a day that it drops down and see maybe another day or two, see if it keeps going down or so, if it's staying in the same range. So these are the things that you want to look out for. But August 20th is just a random day I chose because it was one of the days that it was already down. Yeah, on August 20th, it was at $61.91 a share, right? Down from that $67 price that we were looking at before. So it's definitely still a good time to buy. You could have waited a couple more days. It went down some more, but let's say we bought on that day, for example, right? As you can see, the mutual fund is following a similar pattern to how the Dow is moving as well. So they both are moving in a very similar manner. So now let's say we put $5,000 towards this mutual fund, right? Remember, our goal is to return 10 to 15% of our money. So what we have to do is wait for a day where the Dow hits that much in points, which would be roughly like 27,000 from that 23,000 that it was in. Not that they're going to be exactly percentage-wise, the increase is going to be the same, but if the Dow goes up, usually the mutual funds go up as well. That's just how it works. The percentages might be slightly off, but they'll go up together. And we look at November 1st now. November 1st, we saw that it was rebounding, right? It was already on its way up. And November 1st was a great day to buy. Well, after that, November 5th, to be exact, was the day that it was a good day to buy, to sell it. So on November the 5th, the price was at $67.15. So you could have sold on that day. You would have made 8% of your money. So let's say $5,000, right? 8% on 5,000 is $400 a month. And you made that over the course of less than a year. Remember, we try to target 10 or 15% of our entire money over the course of a year. So if you're doing 8% over the course of a few months, take it. It's gonna go down again within that same year. The market never goes up consistently for an entire year. It'll keep going down and up several times throughout the year. So you definitely want to capitalize on the gains when it comes. Do not be greedy and avoid losses as well. So that's more of a conservative way of doing that. So we keep cycling this over and over and over. We will definitely hit our target of our 10%, 15% on our return every single year. And that's just the best way to save, right? So as I mentioned, for stocks, it's the same way. We just do it on a much more aggressive basis where we're looking at it on a daily or even weekly basis. If it's a stock that you know like conservatively goes up and down, then you don't have to look at it every day. But if you know it's a very stock that jumps up and down all the time, you have to look at it every single day to see how it's going, because you might have made your return on the next day or a couple of days later or a week later. So definitely pay attention to that. These are just some basics. There are more advanced ways to investing in stocks, assets, but these are just some basics to get your feet wet and start investing, because I really hate when people just have their money just sitting in the bank or just has cash laying around in their bedrooms. We should always try to put them into assets to be able to make that money grow and get to our financial goals much quicker, for us to beat inflation as well as have some returns. So please subscribe if you haven't done so already. Drop a comment if you can. Stay tuned for the next video, and remember to continue to inspire others.